Welcome to the Brussels Report podcast. I'm very happy to have as my guest today Charles Dallara. Charles Dallara is most known as the former head of the International Institute of Finance, which I think you could say is sort of the representation of leading financial institutions in the world. He played a very important role when he was acting as the representatives of financial institutions during the Greek bailout back in 2011, when Greece was unable to live up to its debt obligations, and a solution had to be found. Interestingly, before that, he has also served in the Reagan and Bush senior administration. So I will definitely also ask him about that. So very welcome, Charles.
Thank you. It's a pleasure to be with you today, Peter.
Likewise, so I mean, I've been following the EU for a very long time, 2008 really, and I've always maintained that the future of the EU will be determined by perhaps its biggest project, the common currency, the euro. And indeed, when you were absolutely in the spotlight in 2011, Greece was in deep trouble. It could no longer afford to pay its debt. It had trouble refinancing its debt. And then there was serious speculation, both publicly and privately, that the euro may not survive. Even if Greece only, was of course a minor economy within the eurozone. So maybe there's some things you want to recall from that period.
Well, it was an extremely stressful period, Peter, not just for the negotiators, but stressful for the entire eurozone and the entire continent of Europe. You are right, of course, that Greece was in the heart of this crisis. But I step back and look at it, and as I lived through it, Peter, I also viewed it as a broader eurozone crisis. You may recall, I'm sure you will, that Ireland preceded Greece into a crisis position, and that when Greece was in the crisis, it was surrounded by other countries facing serious difficulties, not as severe, but nevertheless under severe market pressure. That included Portugal, Spain, and in particular, Italy. So it was a crisis for the leadership of the Eurozone. I don't disagree at all that the future of the entire project for European economic and financial integration will revolve largely around the prospects of solidifying the euro as the common currency of the region and as a currency that is supported not just by monetary union, but by fiscal union. And I think that as we look at Europe today, still a lot of unfinished business there. As I look back at the crisis time, I think it was an extremely difficult time for Greece, for its citizens, for its economy. Thank goodness it has come through this, and partly because of the determination of negotiators on all sides, Greece survived this period of crisis, and of course, aided and assisted by the largest debt restructuring in history. You may recall that in the spring of 2012, we concluded negotiations on what still today stands as the largest debt restructuring ever. We eliminated in one moment 107 billion euro of obligations which Greece owed private financial institutions. Those were completely eliminated. And we took a substantial portion of the rest of the remaining obligations to private creditors and gave them a 10-year grace period and extended the repayment period out over another 20 years. These extraordinary measures have provided now some wind at the back of Greece as they face debt servicing obligations, which are considerably less than if they had faced restructuring without these concessions. And I think that there's still a lot of lessons to be learned from this period. And maybe it's worth talking a little bit about those lessons as well as the remaining challenges.
Well, absolutely. So I recall back in December 2009, the European Commission came up with a compilation, a booklet, highlighting all the predictions of mostly Anglo-Saxon economists about the euro, how they all got it wrong, how the euro had weathered the financial crisis very well. They were making jokes. What's the difference between Iceland and Ireland? Suggesting that Iceland was in trouble, but of course Ireland was not. And then literally less than 2 months later, Mr. Papandreou, the new Greek prime minister, then had to sort of openly admit that there was a problem and that that his government was not able to continue to refinance itself. And that sort of started off the euro crisis. And as you mentioned, sort of the typical example is given, well, if countries can no longer service their debt, you should basically have transfers, taxpayers from other countries bailing them out, fiscal transfers. And many economists sort of see that as a solution. But then, of course, full disclosure, I've never been a big fan of the euro, despite the fact that it does have advantages. But I mean, first of all, isn't it basically not economically very optimal that you have a system that has to survive by transfers? There's the moral hazard problem, of course. And secondly, apart from the economics of all of it, we're talking about, at the moment, 27 imperfect democracies, but still these are democracies where it is not being seen as evident that citizens have to pay for what citizens of another democracy have decided to allow and have decided to to continue in a neighboring democracy. If I mean, even I guess the people of Cyprus may not be convinced that they have to pay for some of the policies that have been implemented by Greek politicians that were democratically supported in Greece, but not in Cyprus. So don't you think that ultimately those are two very profound, problems with the supposed solution of a fiscal union?
Well, Peter, you raised some indeed very fundamental questions here about how the euro should work during times of stress. I remember very clearly those days when recently elected Prime Minister Papandreou had to announce that the fiscal deficit in Greece is not 5%, it's 7 or 8%. And then a few weeks later, well, it's not 7 or 8%, it's 10 or 11%. And before we went through the full 2-month period, the numbers were up close to 14%. And of course, the markets were shocked. I'm in the process, as I think you know, of publishing a book on the crisis called Euro Shock, how the world's largest debt restructuring helped save Greece and preserve the Eurozone. And I have a chapter on the decade leading up to this crisis called A Decade of Delusion, Peter, because I believe that both markets, politicians in Greece, and politicians throughout Europe really were living in a period of delusion then. Particularly, I am critical of the market's lack of fine-tuned analysis of the risk of lending to Greece during this period. There was a substantial amount of it. And of course, for a period of time, particularly early in the decade, there was a big return advantage, a big spread advantage. I make this point because I think that from the moment Greece joined the euro in 2002, I believe was the initial date, there was always a question, would Germany stand behind Germany and the other northern countries, the stronger economies in the region, stand behind Greece or any other weak economy during a moment of crisis? And of course, there was the no bailout clause, but the reality is that the expectation in the markets was rather different. Does that mean that the market should drive the actual behavior? Not necessarily at all. But the fact is that Greece needed support. Without support of the other countries of Europe and the International Monetary Fund, it would have been ripped out of the euro. And it came mighty close to leaving the euro as it was, Peter. And unfortunately, if others embrace membership of a country with all of its strengths and weaknesses, then they also have to accept a responsibility for supporting that country temporarily during moments of stress. And I think that's what happened here. And actually, I believe, looking back upon it, that had Europe been willing to provide at least a somewhat more gradual adjustment path for Greece, the crisis could have been brought to an end earlier. But there were some other difficulties with this entire negotiation, Peter, which probably we should talk about in terms of how the negotiation actually unfolded and what was the role of Europe relative to the role of the IMF.
All right. Maybe one more aspect about Greece and the euro. People say, well, there weren't any big transfers, before the whole euro crisis erupted. Greece, as you mentioned, which was followed by Ireland, Portugal, Spain, Cyprus, then again Greece, right? And now it's been stable to some degree, facilitated by the European Central Bank. But then already in the decade before, you had the Greek crisis. You could argue that the ECB, the European Central Bank, had already been acting covertly as a means to facilitate transfers. I don't think Greece could have managed to build up the mountain of debt if it still had its national currency, right? Yeah, I mean, with the drachma, the bond vigilantes would have long attacked Greece before, including my own country, Belgium, or Italy. I mean, Silvio Berlusconi had actually been elected on a reform program, but he never actually had to do it because Italy was fully funded, because the Italian banks got financing conditions from the ECB that they would likely never had enjoyed from the Italian central bank. So in that sense, you could argue that from the very beginning, the euro had acted as some kind of a transfer mechanism, facilitating the financing of governments long before you could see this out in the open.
Well, you're right, Peter. Of course, the ECB did provide some support during that decade, but actually, looking back upon it, I'm not sure how critical that was in catalyzing deposit flows. I think it was the actual creation and membership in the euro that gave a false sense of confidence to private investors and private creditors. They assumed, erroneously as we know, that Germany and the Northern Europeans and the entire membership of the Eurozone would stand behind Greece completely in the moment of crisis. And this was a naive assumption on the part of markets, on the part of lenders. And it was a naive assumption on the part of Greek government officials. There should have been a greater awareness during the course of that decade that ultimately they would have to bear responsibility for the loans that they took and the borrowing they engaged in, the bonds they issued during that decade. I look back upon it, though, and realize that there was an implicit support mechanism that came from being simply a member of the euro, which was never clarified until the crisis erupted. And then, of course, there was a big scramble. At first, as you may recall, Greece said, we don't need an IMF program. The Europeans said, we don't need an IMF program. And the IMF went along with this, although there was some early discussion about having an IMF program for them. And then as the crisis worsened during the course of 2010, it became clear that there was a need not only for European support, but for IMF support. And that initial program was launched, as I recall, in the spring of 2010. It was, in the end, an earnest effort, but it was insufficient to stem the tide of pressures on Greece and on the Eurozone, especially at the time as the difficulties in other countries, especially in Italy, were growing. This was the time when you had two elected governments in the south of Europe, in Greece and Italy, which had both lost a considerable amount of confidence in the marketplace As this process went on, it was increasingly clear that there was another question which loomed on the horizon, not just Greek reform, not just IMF and European lending, but to what extent would the markets have to engage in debt restructuring? And that question really was one intensely debated, Peter, throughout the period of 2010 and 11. And in fact, as you will recall, having followed it closely during that period, we actually had a difficult time reconciling that issue. In the fall of 2010, as I was leading the Institute of International Finance, and we were trying to put Greece, to support Greece getting back into the market in a position where they could renew access to capital markets on a voluntary basis. There was a walk on the beach in Deauville by two prominent leaders of Europe, Chancellor Merkel and Prime Minister and President Sarkozy. And that walk on the beach led to a statement, which really, in hindsight, I think, had a lot to do with the underscoring the necessity of a debt restructuring. From that moment on, in my view, the die was cast on the need for a debt restructuring. And finally, in the spring of 2011, over the objections of the ECB, we, the private sector, actually launched negotiations over the restructuring. It's the first time in modern financial history that I'm aware of, Peter, where you had creditors actually negotiating a restructuring. And then, of course, we can talk a bit more about the actual process of that restructuring, if you like. It was a difficult process because it was entirely unclear who we in the private sector were negotiating with on the other side of the table. Was it the Greeks? Was it the Italian deputy finance minister, who happened to be chairman of the Euro Working Group? Was it the IMF? Was it Berlin? Was it Paris? It was never entirely clear, and we went through extraordinarily difficult times just sorting out who we were negotiating with during that period. Finally, though, as you know, we reached agreement on this massive restructuring, but not without considerable difficulty and not without serious mistakes being made by the IMF and the Eurozone.
Well, yeah, and I mean, looking at your CV, you're really an expert, or let's say an expert in practice in debt restructuring, because you've also been dealing during your years at the Reagan administration with the Latin American debt crisis. Now, maybe looking back at that period, so you could say that both in the United States and in negotiations with Latin America, you had sort of similar challenges. Interest rates going up a lot after they had been basically too low, or after the Fed had been taking half-hearted measures, and then Paul Volcker was brought in by Carter, not by Reagan, interestingly, and we saw an enormous increase in interest rates, which you could argue broke the back of inflation finally. But then, I mean, it would be very interesting to hear your thoughts about that period, and then secondly, what we can learn from it today, because since I think now more than a year at least, right? We have seen interest rates going up quite considerably, maybe not as much as during the Volcker era, and we also have governments that are, carrying a reasonably considerable debt burden. The jury is out on to what extent that is actually a problem. Maybe if they tell everybody to work 5 years longer than they thought, it's sort of fixed. That's a default of some sort, right? But yeah, what's your take on that period, and any lessons for today, both for, let's say, internal U.S. adjustment and how the Latin American emerging economies back then had to deal with it?
Well, Peter, you're right. There are a lot of lessons. Of course, the analogy has some limitations, but still, if I look back, and I was a young officer at the Treasury in the late 1970s when Volcker was brought into the Fed, just as you say, to tame inflation. And I saw it firsthand. sitting in the back of the room, a fly on the wall, as they say, in various meetings. And there's no doubt that authorities, particularly in the U.S., allowed inflation to drift upward during the 1970s and found it very difficult to get it under control. And I remember when I joined the Treasury, someone handed me a lapel button that said "win." You may not remember what "win" meant, but it meant whip inflation now. Well, you're never going to whip inflation by handing out lapel buttons. You've got to take tough measures to constrain the money supply. And that's what Volcker did in October 6th, if I recall correctly, of 1979. One of the consequences of this was that an already overextended Latin America, which had been borrowing during the 70s in quite some similar ways to the way Greece was borrowing decades later, found that it was no longer able to easily service its debt. And by 1982, 3 years after Volcker launched his anti-inflationary program, we had the onset of the Latin American debt crisis. It led to a struggle of nearly a decade of working through reforms to address some of the underlying weaknesses in the Latin economy, but also to allow the banks in the US, Europe, and Japan to recapitalize. Had Latin American economies, and if you take just the big four, Brazil, Argentina, Mexico, Venezuela, had they defaulted early in the crisis, the capital of the US and European and Japanese banking system would have in effect been wiped out. We would have been in a global depression again. So we had to buy some time as we implemented reforms, or as the Latin countries implemented reforms there. And I think that, again, there's some analogy here. It was undoubtedly necessary for Greece to implement economic reforms to rebuild its credibility in the markets, but also to address severe imbalances, get its fiscal deficit back under control, strengthen its competitiveness, eliminate a lot of its structural weaknesses, etc. By the end of the decade of the 80s, however, the process of restructuring had begun to lose momentum because there was no actual debt reduction in those days, Peter. It was just rolling over the debt and reducing the interest rates just a tiny amount, so that there could appear to be some concession to the Latin debtors. The strains within Latin American democracies, and the 70s and 80s to a certain extent, had been a period of democratization of Latin America. Many of the previously military governments had elected democratic governments. So we in the States, as well as in Europe, had a strong vested interest in supporting the continued deepening of democratic governments in the region, but the strains were becoming too great. And in the late 1980s, under new Treasury Secretary Nicholas Brady and under the leadership of President George H.W. Bush, we implemented the Brady Plan, which was for the first time a major reduction in the outstanding value of the debt. To a certain extent, we explored in the Greek crisis options for utilizing a similar approach that we used in the Brady Plan. In the end of the day, it did not work out so well, partly because of the lack of confidence that banks had that there would be any future in holding on to Greek debt. One of the keys that I might mention of the Brady Plan was that we collateralized new issued bonds by Mexico and other Latin debtors to a considerable extent, so that the principal and a certain amount of rolling interest, and I think it was initially 18 months, depending on the optionality that creditors chose, would be collateralized by U.S. Treasury zero coupon bonds. During the negotiations of Greek debt, we explored some options like that. In the end, decided not to go that route. But this technique, which created an entirely new capital market access for Latin American borrowers, worked quite well in the course of the Brady Plan. I'd like to stop there, though, and come back to one other interesting aspect of the inflation fighting in the late 80s, in the late 70s and early 80s by Volcker. Today, the market seemed fixated on when and how the Fed and the ECB in particular, but also the Bank of England and other central banks, will finally tame inflation. Now, it's obviously exceptionally unfortunate that inflation was allowed to surge so dramatically over the last few years. One lesson learned, however, is that restoring price stability is not a linear process, and markets should not become obsessed with thinking that everything is on a smooth glide path toward a so-called soft landing. Personally, I think that is one of the worst metaphors that I've heard in a while, a soft landing, Peter, because the fact is the damage is already done to the consumer pocketbook. I mean, if you imagine that recent Boeing jet, which had its door blown off when it was in flight, no one focuses on the fact that the plane actually landed safely, right? The damage was done in the air. And by the time those passengers landed, they were not terribly impressed by the fact that the plane landed softly, right? And so I think that when you look at what consumers have experienced in the U.S. and Europe over the last few years, in the U.S., net prices have gone up 20%, Peter, over a 3-year period. That's a stunning number, and it is in most cases not matched by comparable salary and compensation improvements. So you've had some notable loss in real incomes, and this is why I kind of dispute the whole notion of a soft landing. I just think it's the wrong metaphor, if you would. We've got to learn, I think, just how costly inflation is and how difficult the process of restoring price stability is. The markets are hanging now on every comment made by the ECB, and I guess there's a meeting later this week. Every comment made by the chairman of the Fed, and he's testifying in front of Congress on this Wednesday. The markets are hanging on every bit of that. But the reality is that neither of these central banks has any choice but to persevere in this effort. One final reminder of this period is that Volcker made some dramatic changes to tighten monetary policy in the fall of '79. By the early period of 1980, an important election year in the U.S., those changes were having a dramatic effect on the economy. And in fact, along with some very explicit credit controls, they were actually taking a lot of air out of the economy at the time. It's not well remembered that Volcker backed off temporarily. He allowed inflation to unfortunately recover, Peter, and the cost was quite palpable as we moved through 1980, and we saw that inflation was picking up steam once again. He then brought the hammer down very hard, and that's what induced the recession in the U.S. and Europe. It's what induced the Latin American debt crisis. It was not a linear, straightforward process, even for a man who we rightly regard as a huge global leader in correcting the inflationary tendencies of that era.
Well, correct, because I do think he was also involved in the sort of the U.S. leaving the gold standard back in 1971, right? So he's not all that hard money, all the time.
You're right. He was at the Treasury. He was Undersecretary of the Treasury at that time. You've done your study. You're too young to know that personally, so you've done some good research on that period.
Exactly, but it's interesting that Carter was so desperate, and yet he appointed this hawk, imperfect hawk, which may have cost him the election. Who knows? But then, doesn't that again tell us something about today? I mean, we see central banks clearly very eager to stop hiking. But then, like you say, inflation doesn't just go away like that. You may have to be hard, and if you're not hard enough, if you're not, let's say, a doctor that is tough enough, you may have to be much tougher for the next operation. I'd love to hear your thoughts about the state of the economy, specifically in the West. We have Germany deindustrializing. Some people argue, but I mean, this was ExxonMobil, if I'm not mistaken, also saying this earlier in last month in February, that Germany was in the danger of deindustrializing, which is not a small company, ExxonMobil. We see the energy intensive industry in Germany producing a lot less. Combined with inflation, combined with increased geostrategic tensions, US election year, people are clearly not happy with Biden, and it's not just because he's seen as old and everything, but also underneath, like you say, the economy does not seem to do all that well, at least not for many people. So combined with, at the end of the day, okay, the US has the exorbitant privilege, but I mean the debt levels are very high. In European welfare states, the debt levels are very high. I mean, is this like some kind of a toxic mix? Or do we have to be really afraid, or should we maybe see it in perspective and maybe it's not all that bad?
A little bit of both, Peter. I think actually you made reference to something that I think warrants some discussion, and that is the U.S. exorbitant privilege, the privilege of being the issuer of the world's reserve currency and all the seigniorage, which we as economists understand come with that. I think it's important for the U.S. to recognize, let me start on the U.S. and then come back to Europe, to recognize that that is not unlimited. There is no guarantee that the markets will be in love with you forever. And I think that right now, the lack of attention to fiscal discipline and even a sense of fiscal order in the U.S. is quite disconcerting, Peter. You see the endless dysfunctional way in which budgets are passed in the U.S. There are just some stopgap funding of a number of our agencies over the last 24 to 48 hours. And none of this is done in context of an overall approach toward budgetary planning and budgetary discipline. I don't think this can go on forever. And this is not just a problem of Biden or Trump. It's been a continuous tendency over the last decade or so, really even predating the global financial crisis, but certainly accelerating during the global financial crisis, that our debt has accelerated dramatically as our deficits rose, and they haven't come back down anywhere near the extent they should have during a period of solid economic growth these last few years. We seem to be spending without much regard for the future implications, and the markets will run along with us for a while, to be sure. But ultimately, there is a grave risk that the markets will give the U.S. just enough rope to hang itself, and at some point become frightened, become concerned, probably catalyzed by some downgrades by rating agencies. You don't know for sure. But I don't mean to suggest that there's a crisis around the corner with the U.S. currency or U.S. fiscal problem, but I think that crisis is a risk that is growing as we continue to pursue these fiscal policies that have now moved our debt to GDP ratio above the threshold of 100% and moving it further to the north. Yes, we have the world's largest and biggest capital markets, and there are reforms being made to the bond markets as we speak, which has strengthened the operational efficiency of the U.S. Treasury bond market. But that doesn't deflect from the need for greater discipline in the U.S., and either it gets led by political leaders who can find ways to come together and create consensus. Maybe it's needed to have a bipartisan commission, whoever is president, to take a fundamental look at these issues. But the alternative to that is market pressure, and we know how disruptive market pressure could be. Again, I've lived through many episodes of sovereign debt crisis over the years, and when the markets get scared, they run for cover. And when they run for cover, access to markets is constrained, interest rates go up. And this is also at a time when a lot of foreign central banks are trying to diversify their holdings. So there's some important questions here which need to be addressed. I think that if you look at Europe, I'm slightly more optimistic than a lot of the analysts about the European economic outlook. I'm in the private equity world today. I chair the U.S. business for Partners Group, a Swiss-based private equity firm, Peter. And we still see a lot of opportunities of investing in Europe, both on the infrastructure side and on the private equity side. Now, admittedly, these opportunities need to be very carefully selected. but they're not necessarily captured in the macro data. If you look at the macro data for Europe today, yes, it is pretty bleak, right? What are we looking at? A Eurozone growth prospect this year that's below 1%. We're looking at a German economy which is pretty stagnant right now. We're looking at a French economy which is expected to grow maybe 0.5% this year. The strongest economies in Europe tend to be Poland and a couple of other smaller economies in Central Europe. And inflation is still a challenge, even though the ECB has made considerable progress in bringing it down. It's clear that service prices, the service sector, is being a bit stubborn. And the ECB will be mindful of that, I think, as it decides when to start cutting rates. And so I don't think you're going to have any relief from the high interest rates in Europe for the next few months. But I would also stress that Germany in particular, but Europe as a whole, has been hit hard by the Russian invasion of Ukraine and the economic implications of this. It's been hit hard by the need to fundamentally realign its energy structure. This would not be easy for any country, particularly Germany, which was so dependent upon Russian gas. But I see actually a process underway which need not lead to perpetual deindustrialization, but simply can lead to structural change in the German economy. My own company is investing in a wide range of renewable energy platforms in Europe today. Solar, wind, an interconnect platform which will for the first time allow Ireland and Great Britain to exchange energy on an ongoing basis between the two grids, called Greenleak. This is a meaningful step forward in the direction of greater energy efficiency. And I see Germany making a lot of other moves. Yes, not in the nuclear space, but making a lot of other moves to accelerate the transition to a more environmentally friendly set of energy sources, but at the same time to do so pragmatically. My company has just turned the key on for a floating LNG facility in Stade, Germany, which will be replaced in a few years by a permanent LNG facility, or at least a medium-term fixed LNG port there. There's a lot going on in Europe, which I think will strengthen energy efficiency. You look at Greece's positioning itself now to be a regional energy hub, trying to take energy perhaps all the way from the Mediterranean into Europe, where it can move throughout the energy grid in Europe. Italy is also positioning itself to take more advantage of energy coming in from North Africa. I think the process of change is abrupt and it's painful, but I am not without some confidence that German industry and German political leaders will come to grips with this and see some revival. I think there are some broader issues, however, which challenge the European economy, which need to be addressed at this time as well. Issues regarding the excess of regulation, the administrative burden that many European economies face, the need to strengthen competitiveness and take advantage of the opportunities for a greater efficiency which are provided by alternative generative AI. We've got huge opportunities coming here. And if the leaders can encourage and create incentives for a more environmentally friendly world for venture capital, and that's not beyond the scope of Europe. It's not. You have many talented people. Now, some of them maybe need to be encouraged to come back to Europe. I was just in Greece last week, and they've lost a lot of talented people. And I think there is a growing desire and some movement in bringing those talented people back. But I think it's too easy to be completely discouraged about the European economic outlook, particularly the German outlook. The other thing that, of course, it warrants mention here is the need for dramatic overhaul of Europe's defense policies. Now, this is providing tremendous strain on Europe today. They're doing everything they can. And frankly, right now showing more leadership to the world in supporting Ukraine than the U.S. is. And they're scrambling to provide military aid. But it is against the background, as we know, of a period during which Germany in particular, but most of Europe, thought they had a permanent peace dividend with the end of the Cold War. And they took advantage of this by allowing their military preparedness to really deteriorate. Not every country did this. France and the UK maintained some meaningful degree of preparedness, as did Greece, for different reasons maybe, with Turkey at the border. But the fact of the matter is that it will take some time for Europe to rebuild its defense industry. But as it does this, it can also provide a bit of an economic spark. And people don't seem to see that. The other thing that needs to be discussed more in Europe today, in my view, is labor mobility. One of the keys to our success in the U.S. these last years has been a restoration of the traditional labor mobility in the United States. And of course, this is increasingly important in Europe as you face more demographic challenges than we do in the U.S. Just again, visiting Greece and Belgium last week and seeing the tendency of lower birth rates in many, many countries around the region is a matter of concern. This has to lead to rational inward movement of talent, but it also, I think, encourages the repatriation of talent where you can.
All right, all very interesting. Actually, I want to pick up on the Russia thing. So I wanted to ask you if you agree with the assessment that some people have made, historians, that the fall of the USSR is partly a result of the higher interest rates. It is, and the reasoning here is that investors would sort of abandon some commodities that the Soviet Union was selling in exchange for debt, given that the interest rate on bonds had increased a lot. And according to some historians, this played a role in the collapse of the Soviet Union. I mean, it was of course collapsing anyway. It was, the whole economic structure of it was pretty weak. But this was sort of, according to some, the last push, so to speak. And then tying into that, perhaps central banks should continue to increase interest rate in the West, not just to break the back of inflation, but also to perhaps to deprive Putin of some income. What's your take on that?
Well, I'm not of a view. I've heard these theories and read some material. I'm not of a view that, if you look back at the fall of the Soviet Union, that interest rates and the cost of credit had much to do with that at all. I think the system was broken. It was extraordinarily inefficient, and the inefficiencies of delivering to its citizens were increasingly obvious and this is long before social media, but as information spread through more established media into the former Soviet Union, and there was growing awareness through radio, through television, through human interconnectivity of the sharp contrast between the quality of life in the former Soviet Union and the quality of life in the United States. And I think it became increasingly clear during the 80s that Russia was ill prepared to deal with the defense challenge from the United States. So I don't see the economic factor as having been a major one. Maybe at the margin it contributed. But I certainly don't think that monetary policy in Europe or the U.S. needs to be designed today with a view toward undermining further the Russian economy. Let's face it, the sanctions which have been applied by Europe and the United States to Russia have not been as effective as they could have been. And that's partly because I don't think Europe and the Biden administration are as effective as they need to be in utilizing the soft power that they have with so-called allies around the world when these allies allow violation of these sanctions. And this has been going on in many different parts of the world over the last 2 years during this very painful war. I would also, by the way, and this is a bit of a side issue, but I would encourage Europe and the United States to move much more promptly in seizing the Russian reserve assets and putting them to work for future reconstruction of Ukraine, because this will be a massive need. And at some point, you cannot end up continuing to chase your tail around the mulberry bush on legal issues here. So
Now,
Coming back,
may I?
yeah, yes, please.
Yeah, like a lot of those Russian stocks that have been frozen are held by Euroclear, which is a company based in Belgium. And the Belgian government, but also the French government, has been quite critical against the idea of seizing those Russian assets, seeing it as sort of undermining the trust of the international system. Should we? The Belgian central bank also warned that it could ultimately undermine the stability of the eurozone. Even now, obviously, they may be a little more sensitive to this because there's a Belgian company holding it, and Belgium is effectively not paying for Ukraine because of all the sort of tax income it enjoys as a result of the fact that this particular company, Euroclear, is based in his jurisdiction. But should we not be a little more careful with that and perhaps focus more on weapon deliveries, sort of the method that has already proven to help Ukraine, at least as long as it does not bring us into a direct conflict with Russia, and become a bit more careful with things like sanctions that have historically, not just in Russia, but also, remember Saddam Hussein, remember Cuba, Iran, now Venezuela, have not been terribly successful, to put it mildly. And perhaps, to go maybe closer to your area of expertise also, there's a lot of people arguing that ultimately this may undermine the position of the dollar. Personally, I'm skeptic to that because the dollar is so much better than any alternative, as imperfect as the dollar is. So should we not pause a bit more before thinking to go there and to seize company stocks?
Well, Peter, the reality is we've been on this issue of Russian reserves. We've been paused for almost 2 years now, and I actually appreciate the need for caution and for careful analysis here. We should not just charge pell-mell into this. But I think that you mentioned the importance of rearming Ukraine. Fully agreed. The importance of strengthening the effectiveness of the sanctions, because we have to insist that our allies around the world work with us to close the loopholes. And we have to be willing to bring punishment and consequences if that doesn't happen. But I would say we have to do all three of the above. We need to reinforce the supply of arms, which is designed to, of course, strengthen Ukraine's ability to resist this unwarranted invasion. We have to intensify the effectiveness of sanctions because now they're just like a sieve in the kitchen, letting water drain right through things. And thirdly, though, I see no reason why we don't position these reserves for the reconstruction of Ukraine. I understand the caution exercised by the Belgian authorities with Euroclear there. I understand the caution and concern by the ECB and French and German authorities about the future of the euro. But this is a global problem, in my view, and you cannot expect citizens to forever fund the economy of Ukraine. Put aside the funding of armament sales. You cannot expect citizens of the West to endlessly fund the economic stability and the reconstruction of Ukraine without considering the need for action here. I believe that a legitimate case, I admit it's not ironclad. Nothing in international law is clear and ironclad. And now I'm not a lawyer, I'm an economist, but in looking carefully at the legal arguments on here, there is sufficient credibility to the arguments of countermeasures, that to the case for utilizing these reserves on the basis of international legal understandings of countermeasures, that I believe this can be done, particularly if it is done in unison. And this is where I think European and American authorities are missing the point. If you're going to be concerned about weakening the euro, what does it weaken relative to? It weakens relative to the dollar. If you're going to be concerned about weakening of the dollar's credibility in global markets, what's the alternative? It is the euro. Given the difficulties besieging the Chinese economy today, the Chinese renminbi is not an alternative option at all. They do not even have convertibility on the capital account. And you also see that while the Swiss franc is a strong currency, and I have huge respect for the Swiss central bank, The fact of the matter is it does not want to be, nor ever could be in scale, an alternative to the dollar or the euro. So I think that the concerns are exaggerated. I spent 15 years at the Treasury Department myself fretting about these issues. Will we undermine
really?
the global financial system? Will we weaken the dollar? And I think on balance, the imperative has grown that action be taken in this area, Peter, no matter how difficult and somewhat uncertain it seems to be. And I think it will be a swift blow to Russia when and if it happens.
So weaponization of the dollar for you, it's let's say you seem not convinced that this may ultimately undermine because there is no alternative. Now I'm going to push you a bit. So personally, I'm quite a fan of gold. I'm not that young anymore, but people younger than me, they don't believe in gold anymore. They're all on the Bitcoin train. And in my modest view, let's say the more thoughtful crypto supporters basically only support Bitcoin and do not support any of the other cryptocurrencies simply because they see Bitcoin as a completely decentralized cryptocurrency, which means that if you want to lock up the people behind it, there's nobody to lock up. At least that is theory. I mean, what's your view on that? Is this a complete joke, a scam, etc., etc.? Or do you see any remote possibility that Bitcoin, it's been going since 2011 now, I think, may ultimately emerge as some kind of virtual money where people would save in it? I mean, for a fact, if you want to circumvent know your customer regulations in the West, or if you're a Chinese citizen and you want to take out your savings out of the Chinese jurisdiction, Bitcoin has proven its value, right? It's clearly not as smart to put your savings in it because it's quite volatile. But what's your thought about this?
Well, you're right to point to some of the risks associated with the use of Bitcoin by those who want to evade regulatory policies, those who want to elude transparency. And I think this underscores the importance of a much more effective regime being developed by the Bank for International Settlements and central bankers everywhere around Bitcoin. And I think that they are moving in this direction, Peter. I don't think, despite these problems with Bitcoin, I don't think that we can dismiss the probability that Bitcoin can become an important virtual currency in the future. I think it would be a bit short-sighted of us to do that. I think we should focus on how Bitcoin can operate in a more stable fashion, not just as a transaction, as a means of transacting deals which want to be hidden, but as a store of value. And it's on that issue that I think a lot of work remains to be done, and I think that it has to be done, and it will eventually be done. Anytime there's a dramatic change in the way in which financial markets operate, or in the way in which there is a store of value or a means of transaction in the markets, there's a period of a lot of uncertainty, a period of change, usually a period of some corruption and disorder. And we've seen all of the above here, but I wouldn't discount the probability of Bitcoin becoming a major factor in the decades to come, particularly if regulators can get a handle on it.
Okay. Well, very interesting. Then maybe let's conclude with one more topic, which is the newly elected Argentinian president, Javier Milei, who was elected in a context where Argentinian people were suffering from even higher inflation rates in 2023 than their fellow citizens in Venezuela. So I guess that can explain why some crazy libertarian was elected into office. So my question is, what do you think about him? I mean, he seems to be able to deliver some policy change, seems to have a small surplus in January, a small budget surplus. Has been abolishing 98% of funding for the provinces in Argentina, which is creating problems there. Apparently some of them are thinking to come up with their own IOUs, so developments like that. And specifically also, do you think it's a good idea for Milei And is it even possible to dollarize Argentina? Basically, make sure that the country uses the dollar, or basically, and I think what he really wants to do is to have some kind of, a freedom to use any currency you want. So yes, what do you think about this?
Well, I think that what Milei is trying to do is to revolutionize the way in which the economy in Argentina is managed. And while I certainly don't embrace all of his proposals, and while I certainly do not believe that a dollarization of the Argentinian economy is a practical long-term solution for Argentina, I admire many of the efforts he is trying to make to stabilize the Greek economy, to rationalize a fiscal policy that Argentina can afford. Argentina has been in the hands of leaders and policymakers now for over 2 decades, who, in my view, have not proven to be very sensible managers of the economic fortunes of that important economy. And I think that this provides an opportunity when he can reset the policy framework there. And he's clearly struggling mightily in competition with many of the governors and others to assert his power and his influence. I wish him well. I think that unfortunately over the last 2 decades, the IMF has tolerated all too often, in my view, the misguided policies of the prior administrations. Now I think it is time for the IMF to give Milei an opportunity to see what he can do, and I hope the global markets will as well.
All right. Well, it's great to hear. So thank you very much, Charles Dallara.
Peter, can I conclude on one final note here?
Absolutely.
I think I'd like to just conclude on the note where we began, which is Greece. And it's another encouraging view of Europe. Just having visited there last week, I am once again impressed by how much has been accomplished under the current administration to strengthen the competitiveness of this economy. My own company has a major investment in pharmaceuticals. We're looking at other investment opportunities there. And while a lot of work remains to be done to pull up the difficult intertwined roots of excess regulation, of clientelism, of inefficiencies in the Greek economy, the progress that's been made over the last 5 years has been dramatic. And I think you now see it in the performance of the Greek economy. And so there's a very good story there. It's not one of the largest economies in Europe, but it's an important story to understand, because Greece has been a bulwark for democracy for decades, since the Civil War ended in Greece in the late 1940s. So it's not only an important market-oriented economy playing an increasing role in regional energy issues, but also an important stable platform for democracy in that part of the world.
All right. Yes, I agree, of course, and we all wish Greece the best. It's a great country with fantastic opportunities. So it was a pleasure to have you on, Charles Dallara. So thank you very much.
Pleasure to be with you, Peter. Have a good day.